Welcome back, everybody. We have a lot to talk about today because, quite frankly, there's a lot going on. With recent developments and incidents in the U.S. presidential race, it's looking more and more likely that we'll have a second Trump term when the votes are counted in November. And I'm not going to be talking about those things in detail, but I do think it's important we talk about what it might mean for us as investors and what I think the market's going to be doing both leading up to and after the election. Also, Alphabet, better known as Google, is in the news with the rumored acquisition of cybersecurity company Wiz. So we'll break down what that is and what it might mean. Earnings season is coming up as well, starting this week, so I want to touch on the one or two things that I'm looking to see about each of the companies in my portfolio. And then lastly, I've been looking around and starting to experiment with another brokerage, believe it or not, just to see what's out there. So I'll break that down, why I'm doing it, and hopefully be able to get some feedback from you all with the platforms that you're using. So let's go ahead and get started. Now, after the most recent debate and shooting incident at Trump's rally in Pennsylvania, many are saying it's more and more likely that the U.S. will have a second Trump presidency. And just to be clear, I couldn't care less what your political beliefs are, just like you really shouldn't care what mine are, but it is 2024 and everybody gets mad, so let me just tell you this. I don't belong to a political party. I don't really think politicians really help people for the most part, and whenever I do vote, which is not all the time, I simply vote for the candidate that I think is going to do the best job at what I believe is the most pressing issue of the day. Now, if those things somehow, for some reason, make you upset,
stop it. Get some help.
Now, for the rest of us normal people, we probably just want to know what to expect in the market and if there's anything we should do about it between now and November.
It's been a great year for the S&P, up 18%. You take profits, you sit out political uncertainty, or stick with what's working. Dan Suzuki is Deputy Chief Investment Officer at Richard Bernstein Advisors, and Chris Senek is Chief Investment Strategist at Wolfe Research. Welcome to both of you. Chris, just real quick off the bat, do you have any data or kind of, charts that would tell you, kind of point you to where you'd want to be, or do you do anything right now, or do you just kind of sit and wait?
Hi, Kelly. Thanks for having me on. No, I don't think you sit and wait. I think the train's left the station, right? Investors have been structurally underweight financials and energy and some other earlier cyclical areas of the economy, not knowing at the end of the day if it's truly a late cycle or early cycle environment, because there's very much been mixed signals. And now I think markets are coming to the conclusion, even for the event over the weekend, that the Fed's likely to cut sometime this fall, whether it's September, November, or base case is September. And you potentially have the possibility of Trump winning the presidency and the GOP controlling Congress, which would probably lead to a more pro-growth and bigger fiscal package next year. So the positioning that we've seen, the moves we've seen in position in the last 4 to 5 days, I think have a lot of room to run, namely financials and traditional energy. And I think these trends can continue because the stocks in those sectors are still very much cheap relative to the mag set.
So one thing that I struggle with here is that this information seems to me that it's more meant for people who are more active traders, or maybe they're swing trading based on macro factors. When we say things like look at financials, energy, and cyclicals, we're basically saying that these broad-based categories were down and now they may be due for a correction or to come back on the upswing. But my question is, well, okay, for how long and what time period and to what end? And so that's one thing for us to remember as we see clips like this. We have to think about what our time horizon is compared to the people who are talking on the screen. But even in addition to that, I feel like we need to do more than just look at certain industries or sectors. And the next guy gets into that here.
Kind of bolsters, Dan, the rotation that appears to be maybe gingerly starting to take place. So like Chris said, maybe financials, maybe energy are places you look. But he also said the train has left the station. And again, nothing's ever certain. I mean, is there something to be said for waiting a few months or kind of just, wait till November or even to just say, is it such a sure thing to go with financials and energy, even under the fundamentals that you think would be supportive in a Trump presidency?
Yeah, Kelly, it's a really good question. I think ultimately there's no need to wait for an election. I don't think that whether it's the election or the Fed, I don't think those are actually going to be the swing factors. If you're going to wait for anything, I think you wait to see what earnings are looking like, because ultimately that's going to be the critical factor here. We're just kicking off earnings season. And a lot of these stories that have been cheap and left for dead are really show me stories at this point. They've actually disappointed. Their earnings they have disappointed relative expectations. But this is really a critical period where you should see that broadening out and big acceleration in earnings across the board here. So I think if you're going to wait for anything, I think that's what you wait for. But really, I don't think you need to wait. I think the signs are clear. You want to basically own the companies that are going to drive that earnings acceleration here.
So this I definitely agree with more, but it's likely because the focus and time horizon is longer. And what I mean by this is I can look at other sectors like energy or financials and I can say, yeah, these stocks are trading for cheap. And when I compare them to the big tech names like Amazon or Apple, then it's logical to think, okay, these cheaper stocks should come back up and these higher priced tech stocks should come back down. And they definitely might. But to me, those tech names are still the strongest businesses in the market, regardless of timing or current valuation, because I'm not looking to get in and out of every swing based on macro or market factors. I'm simply trying to own the best businesses that I can. And these are stocks that I still expect to have great earnings numbers going forward because of their dominance, regardless of or even in spite of macro factors. But he explains a little bit more here.
So if that's the case, earnings acceleration is the only story, Dan, then really that takes us back to the Mag 7, doesn't it? I mean, maybe the Fab 5, but that's where we've seen 80% earnings growth, right? That isn't that where you'd go, or do you think we get earnings acceleration in the financials and in energy?
Well, Kelly, that's where I think you draw the distinction between levels and rate of change and direction here. Because certainly, those large companies have the best earnings growth, and it's really phenomenal. But if you talk about acceleration, their growth numbers are actually decelerating here. And so if you really do want to own the sources of acceleration that have been left for dead, it's really in those traditional cheap cyclical areas of the economy that you've seen the rotation into both this week and last week.
Now, I think this is a great point because being able to recognize acceleration of growth as opposed to deceleration of growth is something that is definitely important as you analyze stocks, and we've talked about this before. So how I would take it is like this. If you're taking a more active trading route, look into these beaten down sectors and then finding the companies that are likely to have earnings growth acceleration provides a pretty attractive opportunity. But just know that political uncertainty is likely to cause some erratic behavior in the market. And even if you just look at what's happening today with semiconductor stocks like Nvidia, ASML, and TSM, they're getting hammered, at least partially because of geopolitical risk and the comments from the current administration made about companies exporting to China, plus comments made from Trump about Taiwan. Now, obviously, as an investor, if you think those risks are a big concern, then you might just stay away from those companies. But if you're interested in those businesses because they're still in high demand, then you just have to weigh the pros and cons and understand there's going to be some volatility. And to be clear, if you're an investor with a long-term time horizon and you're not looking to actively trade or get in and out of positions, then this isn't saying you should go dump all your Mag 7 stocks or your semiconductor stocks and buy a bunch of banks or energy companies. And this is another great example of where having your own strategy defined really helps, because it helps to keep these important questions top of mind. Is their time horizon the same as my time horizon? Are they actively trading versus am I actively trading? And does their interest in financials, energy, or whatever sector match up with the criteria that I've set for myself? And that's why I talk about it so much, because it's just such a great tool to have to be able to quickly filter through information that we get to see if it even applies to us. But the bottom line for me personally is I'm not too worried about the election or any political uncertainty until then. While I may look at companies that are at good valuations that might be poised for a breakout, it's always done with evaluating the strength of their business first. And I'm even okay if some of my big tech or semiconductor holdings slow down for a bit, because my view is still that they're going to outperform over the longer term, regardless of what's going on with macro or the political climate. Okay, speaking of big tech, Google was in the news this week at the rumored potential acquisition of cybersecurity firm Wiz.
Now this morning, new reports saying Alphabet is entering a deal to acquire that firm for $23 billion. And that's the topic of this morning's Tech Check with Deirdre Bosa, which, interestingly, Deirdre, despite that big price tag, Alphabet shares are higher this morning. Investors seem to like it.
Because it needs a boost in the cloud, and Wiz would do just that. And it's really hard to overstate just what a darling Wiz is in the venture community. You've got Index, Sequoia Capital, Andreessen, just some of its early backers that would get a big exit here if it does move forward. It was also number 9 on our CNBC Disruptors list this year. When I spoke to Rappaport just a few months ago, he had just raised another $1 billion, valuing his company at $12 billion at the time. He wasn't in any rush to sell or go public, but a Google deal for $23 billion would represent nearly double that last valuation, a huge jump up. In one chart, here is why. Wiz is a cloud-native cybersecurity company, and in just 4 years, it was only founded in 2020, it has very, very quickly been able to compete with the giants in the space, Palo Alto and CrowdStrike. It is now the third largest cloud security vendor by ARR, that's annual recurring revenue, and it's growing more than 3 times faster than the leader, Palo Alto.
Now, $23 billion is a lot of money and would be Google's largest acquisition ever by far. But they do have the cash with over $100 billion in cash and short-term investments on their balance sheet. The question for investors would be if a $23 billion investment in Wiz would actually be worth the cost. And obviously, it's hard to tell without the benefit of time because at the time of the YouTube acquisition, people weren't sure if Google overpaid at $1.7 billion in 2006. But now YouTube is worth in the hundreds of billions of dollars all by itself. And there's no question that cybersecurity is an extremely important and growing industry with the majority of businesses storing their data in the cloud. Not to mention the frequency and severity of hacks and data breaches that are happening all the time. But in general, these large dollar acquisitions frequently see the stock go down for a bit until we see the value start to materialize. Not to mention, there's another big question that still needs to be answered. Can the deal even go through?
Now, Google bringing it in-house would be a huge boost to its own cloud offerings, where it still trails Amazon and Microsoft in terms of market share for infrastructure. But Wiz's leadership in cloud security, that's also why Google may be tempting regulators if it does move forward with a bid, as the Journal reports. Even though Google is a distant third in cloud computing, acquiring Wiz would be taking out a major competitor in this category, cloud security. It would also be Alphabet's largest acquisition ever by a long shot, at a time when its core business is already in the crosshairs of the Department of Justice. But with a more than $100 billion cash pile, Google may be willing to try. Remember, too, that these deals take time. If we get another Trump administration, I know you guys have been talking about it this morning, Google and the other mega caps, they may be anticipating a friendlier regulatory environment for M&A, making them more likely to try these things. Remember last week we were talking about HubSpot, that deal being off the table. It's clear that Alphabet wants to do something to boost its cloud offerings.
So that could be another potential change in the market environment if we do get another Trump presidency, in terms of more appetite for M&A with the big tech names that have a lot of cash to spend but basically can't do anything without being put under regulatory scrutiny and lawsuits. So we'll just have to see. Okay, next up, earnings season is right around the corner, starting this week, and so I want to give a quick breakdown of 1 or 2 things that I want to see from each of the stocks in my portfolio. And I'll do them in the order of their earnings date that they have coming up. So first off, American Express. Now, for Amex, I want to see total revenue up and portfolio quality in terms of delinquencies and write-offs still strong compared to their peers. They've been strong in this area for a while and on a great run overall as a stock. I just want to see that continued overall growth and health of their portfolio, and hopefully no signs of a weakening core customer. Now, with MSCI, I want to see if their retention rates and operating margins have stabilized from the previous quarter, and that's specifically in their index and ESG business segments, since those were down pretty significantly last quarter. Now, in terms of Alphabet or Google, I'm looking for continued rapid growth in their non-search business segments, as well as continued increase in their overall margins. For Visa, I simply want to see, is their double-digit growth and high profitability story still intact? Do we see any weakness with the economy? Do we see their growth story slowing at all? Now with Valero, how was their free cash flow generation for the quarter, and how much of that did they return to shareholders in the form of share buybacks and dividends? In terms of Amazon, it's simply, is their amazing free cash flow growth and profitability story still going strong? They've been on a tear lately, and hopefully that continues. For McDonald's, how are comparable store sales doing? Are they still growing? And did the $5 meal deal make an impact in the U.S.? There's been a lot of articles predicting that they may disappoint with earnings this quarter, so we'll see. With Meta, is the revenue growth and operating margin story still going strong? We know already that they plan to spend more on AI, so it'll be interesting to see how much that actually was. Plus, I saw that Mark Zuckerberg is actually going to be joining Jensen Huang to talk about Gen AI, so the bromance continues, and I love it. All right, next up is Caterpillar, and I really want to see if their margins are continuing to improve, and if their full-year revenue guidance is still intact. Plus, how high they'll be raising their dividend, since this is usually the quarter when they announce that. In terms of Apple, I want to see where the overall revenue growth and services revenue growth ends up for the quarter. And this is going to be a really interesting one to me, because the stock has been on an absolute tear, even without any real growth, which I've talked about before is still kind of following their normal refresh cycle. But I'm curious to see what happens if Apple announces another flat to low single-digit growth quarter. Either way, I'm not planning to get out of my Apple shares, but it should be interesting nonetheless. Now, NVIDIA's earnings are still about 6 weeks away, but again, it's a simple question of if the growth story is still intact. Everyone out there is saying it's going to slow down, it's time to get bearish, and personally, I just don't see it happening yet. So this quarter will again be about whether or not their growth rate continues to exceed market expectations, and we'll just have to see. All right, Lulu is even further away since they just reported earnings not too long ago, but the stock overall has been getting hammered. So I want to see if their growth rate continues to be strong as it has been, specifically outpacing their competitors, and if growth in North America starts to pick up again. But as always with all of my stocks, I'll be evaluating their earnings reports, looking at their transcripts, and seeing if the story that I bought into originally is still intact. And if it's not, how strongly I believe that they're going to get it back on track. All right, so lastly, I've been looking around and experimenting a little bit with a new brokerage platform, believe it or not, namely Fidelity. And now, if you're an OG of this channel, you might remember when I initially started showing my portfolio about a year ago, I was in the process of consolidating my different accounts to Schwab, mainly because I wanted to use their portfolio tools and I generally like their service. And to be honest, those things are still true. Schwab's platform's pretty good, the portfolio tools have been pretty good, and their customer service has been excellent anytime that I've actually needed it. But there are a couple things that I don't really love. Even though the portfolio tools have been pretty good, specifically around being able to see my full portfolio across different account types has been kind of a pain, and I think it could be better. The overall cash yield at Schwab is pretty poor, both in your brokerage account and even in their savings account. So if you want to get good yields, you have to invest that money into like a treasury fund or some kind of money market fund. Plus another annoyance is I can't actually transfer contributions into my small business 401k electronically. I have to bring a check and a contribution form down to their physical location or send a wire, which is just annoying. And then lastly, the mobile app experience, at least in my opinion, could really use a refresh. And it's at a point to where I don't really use it to even check on my portfolio hardly ever. And that's not to say that I'm unhappy with Schwab. I just felt that it was time to take a look around and see if there's any other available options out there. But the reality for me is that the only realistic other option is Fidelity because of all the different account types I have. And primarily it's because of my small business 401k and my HSA account, since those are the more unique ones. And just the ability to have them all together on one platform with my regular brokerage and IRA accounts to see them together. Now, I've heard amazing things about Fidelity's HSA, and I at least want to dig around in their portfolio tools to see if I can get something similar to what I'm doing now. The funny thing was, I noticed that JP Morgan Chase brokerage added a benchmark-based performance chart to their portfolio tools, which actually looks really good and clean without a lot of unnecessary noise. And I have that Chase brokerage account to keep my emergency savings into treasury funds, which I don't usually talk about much on the channel. And honestly, if they had an HSA and a small business 401k connected to this experience, I would strongly consider it because it's the type of functionality that I really want to see without a lot of the extra stuff. But they don't, so they're not really an option. But anyway, I've opened a Fidelity brokerage and put some money in there just to look around and see what they have. But I would love to hear from you all as to what you're using for your brokerage, especially if you're using Fidelity, or even better, if you've used Schwab and Fidelity both. So definitely let me know down in the comments what you're using, what you liked, what you didn't like, and then I'll probably do a follow-up here maybe in a couple of weeks after I get a little bit more time to play around. But if you want to see how I'm using Schwab's portfolio tools now, you can check out my latest monthly recap video by clicking this right here. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you on the next one. Peace.